Good morning, everyone. Good morning, Josh.
Morning, Dan.
Thanks for joining us. Q4 2022 market update. We've got a lot to cover here. The thought is we're going to go through looking back 2022, specifically Q4 2022. We're going to look ahead. Why not? It's January. That's what we do. We're going to talk about some trends, themes, and takeaways. Talk through some upside downside, which I think is a great piece to talk about. We're going to talk about market dynamics if we have some time. And then last is macro view. So with that said, why don't we get started? What happened last year, Josh?
Great, thanks, Dan. Not a whole lot. We got a dog for those at home. No, it was obviously a really eventful year for the markets. We ended on a high note, so we look at Q4 for a moment, just in isolation. And the U.S. stock market, as represented by the CRSP total market, was up about 7% for Q4. International stocks did even better. Real estate was up, bonds were up about 2%. But when you look back over the full calendar year, obviously a lot more red and, frankly, entirely red. There was really no place to hide. So U.S. stocks last year were down about 19%. International equities down 14 to 20. Real estate was down, and bonds, and we'll talk a bit more about this, was really, I think, one of the bigger stories, down 13%. The one thing that we would urge all of our viewers, though, is to kind of take a step back. As bad as it was last year, and we can say that now that the year is over,
Right.
When you look back a few years, right, the market's actually up almost 25% going back to 2020, right? Pretty remarkable when you consider what's transpired in that time. We have global pandemic, right? Russia, Ukraine, through all the ups and downs, we've got an average annual return of just under 10%. And, sure enough, that's pretty much what the market does over time, despite a tough 2022. Right? When you zoom out a bit, the returns look a lot better.
And we obviously focus on endpoint bias, right? So 2022, it's in our minds, right? Very easy to forget 21, 20, and so on and so forth. So let's keep going.
Yeah, so endpoint bias is a funny thing. And, talk about zooming out, talk about perspective. We had really super normal returns for a period from 2019 to 2021. And by that, I mean the S&P 500 was up over 100%, right, for that 3-year period. So the notion that markets decline, right, the S&P was down 18, coming on the heels of 100% return, right, is not terribly surprising or alarming. Some might argue it's a bit healthy that we pull back and retrace and catch our breath and kind of set the foundation for the next leg up. And again, when you look at the full period, 2019 to 2022, right, the returns look a lot better. As bad as it was last year, say for growth stocks, for tech stocks, right, they were up 141% leading into that. And if you're a long-term investor, as our clients are, that's par for the course, right? That's kind of the price of admission that we have to pay. We have to endure these bad years periodically in order to allow us to reap the higher returns over time.
Right. And we're going to talk about this a little bit in a few minutes, but growth being down almost 30%, value outperformed.
Yeah.
Right. Fixed income being down. Like these are some things that have not happened in markets in a while. So as we dive in, we'll cover those topics. So you were away last week.
Yeah.
Right. You had time to sit on the beach. You had time to relax. It was great. Obviously, you also had time to reflect, right? And I think what 2022 brought us was some really interesting headlines. What's your takeaway right there?
Yeah, so, last week, I'm still kind of getting caught up, but my kids were playing on the beach and I was reading Capitalism Without Capital. Shout out to Kai Wu if you're watching, Kai. But it gave me the chance to look back at some of the year-end some of the year-end research that comes out. There's no shortage of reports. This infographic right here from Goldman, I think does a good job of kind of telling the story in headlines, and we'll get through a lot of these headlines. Things like interest rate, inflation, right, Russia, Ukraine, crypto crash, 219 days, right, market volatility. There were 219 trading days in which markets were up or down, right, 1%, the most since 2009. So it was a really incredibly volatile year. The one that really jumps out to me though, one all-time high. So when we look at recent market performance, 2020 to 2022, you know, we kind of refer to this as like the buy the dip era.
Yeah.
Anytime the market went down a little bit, 3%, 5%, it was a buying opportunity. You would buy, and there would be new all-time highs a few weeks thereafter. We had 114 new all-time highs from 2020 to 2022.
Yeah.
In 2022, it's actually January 3rd.
First trading day of the year.
First trading day, right? Markets are closed on New Year's, but otherwise, the very first trading day of the year. Throughout the calendar year to the point where they never actually attained new all-time high. So that's, you know, really a regime change of sorts, where we're not seeing the same buy the dip mentality. It's not working like it has the past few years.
Yeah, that's super interesting, Josh. And what's also interesting is, as we fix our camera here, we had also anomalies, you know, specifically equities being down as much as they were, but also in fixed income, right? So as we're building portfolios, as we're looking at portfolios, we want diversification. Let's talk a little bit about some of those anomalies, not just January 3rd, market reaches all-time highs.
Yeah, and that's a great segue. And you know, we talk a lot about bonds, stocks and bonds being the building blocks of a well-balanced portfolio. And as bad as it was for stocks, right, in relative terms, it was actually way worse for bonds. It was the worst year for bonds, right? 100 years of data. Bonds were down 13%. A bad year for bonds is when they're down 2-3%, right? To be down double digits in bonds is really unprecedented. And then you couple that with the decline in the equity markets, right? It was the seventh worst year for US stocks going back to 1926. You put all of that together and a 60-40 type of balanced portfolio, right, down 16-17% for the calendar year, right? One of the worst calendar year returns for a balanced portfolio. Now, Dan, you and I were just talking about this a minute ago. You know, calendar returns, calendar years are one thing, but there's nothing magical about, you know, December 31st, January 1st. You know, when we look ahead now, even up until the first few weeks of 2023, the same balanced portfolios that were down 15, 16, 17% for the full calendar year are now down 6-7% over the trailing 12 months. And it just speaks to that endpoint sensitivity, right? You pick your starting date, your ending date, you can tell a different story. But fortunately, you know, 2023 has been off to a good start. And when we look back over the past 12 months, it paints a slightly rosier picture.
We'll talk about that in a moment. So obviously we've got down double digits in fixed income, which is quite rare. You know, typically we see bond market, stock markets kind of operate on this normalized bell curve. You know, the equity market's typically +10, -10, right? That's maybe call it 1, 2, 3 standard deviations. And then we've got the bond market, which is +3, or rather -3 +5. Let's look at that chart. Let's talk through that, because to me, this is mind blowing that everyone's on, you know, 22, both players are on the left.
Yeah.
Right. We got to get them back to the right.
Yeah. So this is one of my favorite charts to that point. If we didn't have enough data now, you know, this is going back into the 1800s even. Looking at historical returns for stocks as represented by the S&P 500 and bonds, looking at 10-year treasuries. And this is from Alpine Macro as of end of October. And at that point, right, markets did rebound a bit, right, going through year end. But, you know, at that point late in the year, this is the bond return, right? This was, again, the worst ever, right? Over 150 years of data plotted against, right, a total distribution of returns in other calendar years, right? 1878, for instance, right, between 5 and 10%. And then on the equity side, right? All the way again on that left hand, like that fat tail. So to see both of those at the same time is really quite jarring. And to give you a sense of really just how rare that is, here on the left-hand side, they're plotting US bond returns, US stock returns, and we know most of the time, stocks and bonds are up. Most years, right, we've got positive returns, but not every year, right? Some years stocks are down, bonds are up, bonds are down, stocks are up. To have them both down at the same time, you'd have to go back to 1969, right? And the reason is that there are different drivers for stock prices and bond prices, right? You're looking at interest rate and inflation primarily for bonds and earnings for stocks. And what generally happens is when market participants get spooked, as they have, right, in 08, 09, and we see it again in 2020, there's that flight to safety. They buy bonds, right? And that causes bond prices to go up, right? Interest rates decline, bond prices go up as monetary policy shifts to help with the challenging conditions. That didn't happen last year, right? So for the first time in a long time, both stocks and bonds were down. In fact, you've got to go back.
Well, this is my favorite chart.
Yeah.
Right? It's so telling, right? Typically, what we know of, stocks down, bonds up.
Yeah.
Right? Here's the chart right there.
Yeah, and that's exactly right. So here on the right, even 2008, right? We all remember stocks being down 37%. And certainly, high yield bonds and riskier credit was down as well. But the Barclays Ag, the bond index, was up 5% for the year. Last year, you've got the S&P 500 down 18% and the Ag down 13%.
Wow. And high yield, obviously.
And high yield.
And munis sort of down, similar in line with the Ag.
Yeah, so really no place to hide. Challenging year, but
I think that's sort of exciting because you've got sort of this almost 40 years of bond yields coming down, right? With not even a head fake over those 40 years.
Yeah.
Right. So now it's, one could say, hey, opportunistically, bonds, there could be some interesting in the future for the bond market.
Yeah, I mean, look, when you tell me that bonds just had the worst year in 100 years, right? To me, right, I'm thinking buying opportunity. Right. Now, humans behaviorally, and it's not only us, it's Wall Street, right? The narrative always follows the price. So,
and also, it's also worth noting specifically on the bond side, it's not because of defaults.
Yeah.
Right. It's all about price movement. Right. And it's supply and demand driven.
Mm-hmm.
Right. So if we had massive defaults, it's a different story. So, all right. I think 2022, we've put in the rearview mirror.
Yeah.
Right. We've had enough of it. Let's move forward to 2023. I love January because Wall Street gets to flex their muscles and see who's going to be right for the year, see who's going to be wrong for the year. And they all make these predictions. So no different than the weather folks. What are the chances that this year's predictions are going to be right?
So the joke, Dan, you reminded me, why did God create stock analysts? To make the weather forecasters look good, right? So I didn't come up with that one. It's an old one, but yes, this is kind of Wall Street's favorite game. Is the end of the calendar year, they all get together, the best and the brightest and the smartest minds on Wall Street at all the leading banks and brokerage firms, and they put out their full year, expected returns or estimated returns for the market. And what's noteworthy about 2023, down here is it's the first time, I think, since 1999 that the consensus is negative, right? Most years, not surprisingly, the leading analysts project that markets are going to return somewhere around 6, 8, 10%.
Of course they would.
Of course they would, because nobody gets fired for making that type of prediction, right? You don't get fired for being wrong conventionally.
Yep. Going back 100 years, average market returns 10%.
Yeah.
If I was getting paid to make a prediction, I'd pick the averages.
So that's career risk right there. With that said, it's always, it's always interesting, and I think it is telling as well to just, take a look at consensus and take a look at sentiment. So, here are some numbers. This is from December 4th. And at that point in time, the S&P was trading at around 4,100, if I'm not mistaken. So,
you got what, -8 plus, -8-ish, plus 10%?
Yeah, most. I mean, Deutsche Bank, I guess, is most bullish, right? You're talking about like an 8-9% increase. Nobody, right? And then B of A, Goldman, HSBC, Citi, look at how many banks are predicting a decline for the full calendar year. And what's interesting is how wrong they've been in the past, right? This is nothing new. We mentioned it. But to me, beyond that, right, is really what that says about market sentiment and market positioning. And there's a lot that we can take away from that. So Bank of America puts out a global fund manager survey every month, and they show you how the smart money is positioned. And what we're seeing here from December, right, the net percent of allocators that are effectively underweight equities.
Right. So this is smart money. This is big institutional investors. These are big hedge fund players, and consistently, right, they're most pessimistic.
Correct.
Right? And now history obviously shows you that most pessimistic followed by
most pessimistic. Well, it doesn't take much. If you think back to March of 2009, right, that was the low from the great financial crisis. May of 2020, right, we think back to COVID, we were still in the throes of it, right? The market bottomed at the end of March, but folks were still positioned very, very defensively at that point in time.
3 weeks, 4 weeks down 30+%.
Yep. And again, the narrative always follows the price. So it's easy to be bearish when the headlines are bad and when the market's already declined 25%. Harder to be constructive in that type of an environment. And, talking about smart money, we look at retail, same thing, right? We're seeing some record levels of pessimism, right, over the past few months. This is the AAII survey, bulls versus bears, much more bearishness. And historically speaking, when that has happened, it's often preceded pretty strong returns. So it's not predictive by any means, but I think it is nonetheless instructive. And then just look at how much cash, everyone talks about cash on the sidelines, right? There's a lot of cash, right? Nearly $5 trillion in money market assets. And what happens if the consensus is wrong? What happens if things aren't quite as bad or catastrophic as sentiment is leading them to be? All of that cash now has to get put to work. All of that cash is now going to be flowing back into equities. And what does that do to equity prices? Supply and demand, right? So, that's the other side that I think we're not really hearing about as much as perhaps we should.
Yeah, no, it's great takeaways. And, for those prognosticators, I wish them lots of luck. But, the one thing they know is they're probably going to be wrong. It's just how much are they wrong? So obviously, there's 2022. We just talked about some forecasts. Themes, trends, and takeaways. Something that you bring up on our investment calls all the time is that, there's themes that go on in the marketplace. Some are written, and some are, we are waiting for them to appear. So if we could, some of the themes that happened in 2022, right? Yes, we've got the headlines, but internally we talk a lot about, what's gone on, what's happened, what's been the big move and change. So talk to me about some of the trends or themes rather that appeared in 2022.
Yeah, great question. And I think the biggest one, we highlighted it here, right? And we've all heard about it. We all see it anecdotally, right? I mean, we're still seeing it.
It's eggs.
Eggs, right? It's always eggs. I don't know why it's eggs as opposed to milk or flour or sugar, but yeah, the price of eggs, the price of gas. We're feeling it at the pump. Inflation has been and continues to be the big story because inflation is what really forced the Fed or led the Fed and central bankers globally to throw the kitchen sink in the form of monetary policy at it to combat inflation. So when we ended 2020, right, started 2021, right, inflation's at 1.4% as measured by the CPI. By the end of 2021, it was at 7, and it ended 2022 at 7.1. And over the course of 2022, the Fed went through a series of really extreme rate hikes, taking the Fed funds rate from 0%, the lower bound, all the way up to 4.25. And to give you an idea of how extreme that is, right? They began the year, right, really predicting or forecasting, again, 0.9% on the Fed funds rate. And
like in Fed meetings talking about
the FOMC
not raising rates because they think they've got it under control.
Right. So this is the FOMC, the committee itself, right, to start the year talking about how they've got it under control. And even by June, there were a couple of smaller hikes, but at June we're still at 1%, right, below 1%. And then all of a sudden, right, we got 4 consecutive 75 basis point rate hikes, right? And there'll likely be 1 or 2, hopefully smaller hikes to come, but to see that steep of a move in that short of a period is really, really quite remarkable. And that's what mathematically, logically, intuitively, that's what led to the significant moves in fixed income prices and equity prices. And it's math, right? It's not a global pandemic. It's not a liquidity crisis. It's not credit, right? It's pure math. But that's precisely what happened over the past year. And inflation being really the big story. So I think it's probably worth spending a couple minutes talking about that, because that's what's been driving markets for the better part of the year now. And I mentioned CPI ended at 7.1, and obviously eggs, we're still feeling it, but there's a lot more talk now that perhaps inflation has already peaked, perhaps the worst is behind us, right? We don't have that crystal ball, but I think what's really interesting when we look at some other indicators, right? You look at some CPI data, right? And that goes back 12 months, year over year. Now, if you take the 3-month and you annualize that, it tells a very different story, right? So think about gas, right? A year ago, right? Gas was pushing $6 a gallon, I think, at the peak, right? It's down significantly from that point. If you look over the past few months, it continues to go down, but it won't be till February that the 12-month data catches up. And I think that's a microcosm of what we're seeing now.
Well, that's any economic indicator. And we'll talk about that again later on, but economic indicators are backward looking.
Exactly.
Right. And they're delayed and they get revised.
Exactly.
Right. Whereas markets tend to be forward looking.
Exactly. And that's the challenge, right? The Fed is looking at the year over year CPI data. But that I think maybe masks the fact that things are getting better, right? 30 some odd % of that is based on housing. And rents have been going down for the past few months. You don't see that in the data. So you look at core goods, for instance, year over year, you strip out some categories, the data already looks a lot better. The other thing that I think is really, really interesting, people have been talking about or calling for inflation and hyperinflation for quite a while, right? Really since 09, 010, when we embarked on this easy money era. It hasn't happened, right? Here's CPI, it hasn't gone up, it only went up. Right here, 2020, 2021, that was COVID. So M2 or money supply, right? That I think has been the real story. It's not that we were cutting rates or keeping rates low. It's that once we started sending checks to everyone and literally increasing the money supply to unprecedented levels, right? That we saw inflation pick up. And look what's happened to M2, right? So reasons to be optimistic about inflation. One more reason to be optimistic is just supply chains, right? That was a big story last year.
Big story.
And look what we're seeing. Those shocks, right? We're already seeing that easing within the data.
Right. Well, those are anecdotally, those are the stories that we keep hearing. And to the point of we're even starting to hear that the supply chain almost swung the other way. Right. So we actually might start to see some prices come down. On the goods that we use almost every day, chips for cars and so on and so forth.
Target shoppers.
Exactly. So let's move on a little bit to sort of, in my opinion, the biggest takeaways as we look at portfolios One thing that we've sort of always talked about here at Revolve is, you have to be diversified. You have to have growth stocks. You have to have value stocks. What we also talk about is you can't only have FANG stocks, right? Because at some point that's not going to work, right? And so walk us through value growth, some other themes that you might see in the marketplace that these folks joining us today might want to see and might find interesting.
Yeah, so great segue. Value growth, right? Up until this past year, growth has dominated, right? US markets, global markets for that matter. Growth stocks, the FANG stocks, right? Facebook, Apple, Amazon, Netflix, Google, or whatever they're calling themselves these days, Alphabet, Meta. But they've been dominant, right? Last year that reversed. Last year it was energy, it was utilities, right? It was, chemicals, it was consumer staples, and growth really lagged. And
everything but Apple.
Yeah, you can see that dispersion. This chart, right? Take Apple, right? Largest company in the world, down almost 27% last year, right? The generals, Microsoft down 29, Google down 39, Amazon got cut in half, right? Down 50% for the calendar year, Tesla down more. Meanwhile, ExxonMobil and Chevron up 50, 80%, right? Healthcare, right? Aerospace and defense. So the boring sectors and the boring stocks, right? And the stable cash flowing businesses, not surprisingly, right, do better in an environment where monetary policy is not quite as accommodative, where earnings start to matter more and the cost of capital isn't quite so cheap.
What's also interesting, sort of, if you go back, this slide, it's also interesting because what it's showing is the size of the boxes are indicative of the size of the exposure in the S&P 500. So it's not an equally weighted benchmark. It's very much a benchmark based on the market capitalization of the stocks. So clearly you could see Apple, Microsoft, those stocks go down, right? Google, Amazon, Tesla, those stocks go down, right? It drives markets down, right, as a whole.
Exactly, and that's, for better or worse, the way cap weighted indexes work. And here you can see, even with the recent reversal, value still has quite a way to go to catch up to growth and their dominance over the past 10 plus years. We talked briefly about the FANGs, but I think this chart does a really good job of just driving that point home, right? S&P down about 18%, NASDAQ was down closer to 30. And these FANG stocks, right? Meta, Amazon, Alphabet, right? Apple and Netflix down, about 45%. And these are the stocks that for the past 10 plus years, you bought, you owned, and they kept going up no matter what.
And it said they'd never go down.
They never go down. Well, this is, another example of why.
Speaking of going down,
why we diversify.
Let's talk about another, that whole meme stock mania.
Yeah.
Right. This is always interesting too, when, sort of cocktail fodder or call it backyard fodder during COVID, everyone was buying the stock. Well, how are they doing now?
Yeah, well, everyone, I heard someone refer to these as like malinvestments. But these stocks were going up at ridiculous rates based on fundamentals, but literally based on jokes in the backyard. And that's not how markets are supposed to work if you believe that markets are largely efficient, right? So GameStop, we all remember that saga. It's down 85% from the high, right? BlackBerry, AMC Entertainment, like this was literally a joke. And the stock was going parabolic. It's down 94% from that high. Right, folks are buying these names as a joke. They're buying memes, and they were going up and up and up and up until they didn't. So we joke like
I do miss Blockbuster.
We miss Blockbuster, but we joke like nature is healing, right? Like that's not healthy. That's not sustainable. And so if it took the Fed to raise rates a handful of times to see those prices come down to normal levels, well, it's not a bad thing. And what we're seeing now is the other side of that, right? So, some of the biggest winners, Peloton, right? My wife, if she's listening, will probably yell at me to get on mine, but it was up 434%, right, in 2020.
Yeah.
And look what happened since, down 95. And now for that full period, remember, zoom out, perspective, right? 9.65% up on the S&P. Peloton over that full period is down 72. I really got to get back on mine. It's at 72%. So nature's healing. It's not a bad thing. And then I think we'd be remiss if we didn't just mention one other headline from the year. And the past few years, for that matter, housing, real estate.
Absolutely.
So eggs and Zillow, right? Those have been the big things that
Right.
we're all talking about. Look at what happened with home prices, and now look at what's going on with mortgage rates. So, that's going to be another important trend to follow, I think, in the year ahead.
Yeah, and I think, specifically with mortgage rates, historically, we go back, it was not 2% is the anomaly, not being back at 5%.
Yeah.
Right. And obviously we've seen a massive boom in home prices. Like some of the size of the tickets on these homes, got bigger and bigger and bigger. But when rates are at 2 and 3%, that becomes affordable. Now, we'll see what happens, with 5% mortgage rates.
Yeah.
So with any type of downside, we have to look at the upside. So, play on words, the upside of downside. Josh, so let's kind of shift gears a little bit and let's talk about positive spins, right? Markets, this is not the first market to go to decline, right? We've got some history behind us, right? Not that it's going to necessarily repeat itself, but we've got some history behind us. What happens typically after markets decline?
Yeah, and fortunately, I'm not paid to issue year-end estimates, so I think I have the luxury of being a little bit more objective, constructive. We talk about being evidence-based in our approach here at Revolve. So, markets have obviously gone down before. They're going to go down again at some point in the future. That's how they operate. And there have been instances where markets have gone down, like 2008, and the following year they've gone up significantly. There have been instances as well where markets have gone down, like 1931, and they were down again the next year. So there's nothing magical about this, December 31st, January 1st thing, but I think what is instructive is when we look back, right, and this is really post-World War II era, because some of those figures are muddied by what happened during the Great Recession and Depression era. But in 18 instances, right, in which, in the 21 instances in which stocks declined, in 18 of those instances, they rose the following year. And I believe in 9 of those 18, they were up by 20% or more. So it's incredibly rare to see back-to-back declines. Doesn't mean it can't happen or it won't happen, but it's not the norm. Last year was really bad. And so, when we kind of try and project ahead to this year, markets could be down, but it wouldn't be the norm.
Right.
And
it also doesn't hurt, right? If we kind of zoom back out, 75%, here you go, 26 negative calendar years out of 97, going back to 1926. 75% of the time, the equity markets do rise, right? That could be 0.5%, it could be 30%, but they do rise.
Exactly right. So we know that markets historically, equities go up about 3 out of every 4 years, on average about 10% a year. What's interesting is the average return, right, and the median return, in fact, for stocks in the year following a down year is higher than those historical averages. Again, this is not predictive. It's not a forecast, but I think it's nonetheless encouraging. And when we see extreme moves to the downside, like a 25% drawdown, which we saw last year, right? This is data that Goldman put out. When you look what happens the following 1, 3, 5, and 10 years, right? There was only one instance where 1 year out stocks were negative, down 5%, right? 3, 5, 10 years out, they've been positive historically, and positive by a really big amount.
Good number.
Yeah. And, I think that speaks to market dynamics, right? We kind of give this metaphor of it being like a slingshot, like you have these sharp reversals.
Yep.
And that almost paves the way for the next leg up. And we've seen time and again, right, really steep declines, right? We don't know if the lows from 2022 are going to end up being the lows for this period. That remains to be seen. But following the COVID lows, 34%, we got 113% upside, right? Following the 08-09 lows, right, 57% peak to trough decline, we got 400%. And when we look even beyond equities alone, right, you look across all major asset classes, 94%, we joke there was no place to hide last year. But look at what's happened in other years where the majority of asset classes were down or negative, right? The following year,
Or a
Very
series of
few.
years.
Yeah, series of years, great point. Very few of them were negative. So this is not predictive, right, by any means, but I think it's worth noting nonetheless.
Right. And I also think those intraday, intra-year, intra-month declines, that's sort of par for the course.
Yeah.
Right. So even if you are, I mean, prior to 2022, we had this incredible 10-year period. There were still many drawdowns all along the way.
Yep.
All right. Again, we're talking endpoint to endpoint. You know, I always say calendar year to calendar year, you know, no financial plan was driven by 2 different calendar year points. It's driven by a lifetime. So
Yep.
moving on a little bit, let's talk about just at the asset class level, right? So
Yeah.
we've talked about broad S&P 500, right? We'll call it the US market. We talked about fixed income, you know, again, US fixed income markets. But what if we drill down to investment grade bonds specifically versus high yield? Let's talk about S&P, let's talk about treasuries.
Yeah, so, you know, on the theme of the upside or downside, right? The fact that yields today, right? I mean, this is kind of remarkable to me. When you look at high yield bonds at the end of 2021, rate today is now almost in line with the high yield rate of a year ago. And all else equal, right? Higher starting yields, right? That's a positive. It's a positive for bonds, for clients who want income from their portfolio, right? That's a positive as well. So yields have gone up and PE ratios, valuations have gone down, right? Because as bad as things were last year, it's not really declined. It's the multiple, right? The price that people paid for those earnings. Earnings were actually up about 5% on the year. So all else being equal, lower starting value, cheaper stocks, right? Coupled with higher yields, that's really a great recipe for long-term investors.
Yeah. And, you know, only time will tell whether what number was actually real, right? High yield at 4% yield, right? Sitting on top of non-existent treasury yields, right? I mean, think about 3-month treasury at 6 basis points, the 1 year at 1.5%. That's sort of, you know, sort of uncharacteristic of that asset class, you know, if you go back many years. And the spread between the high yield and the risk-free, in essence, you know, it's a normalized, we should see getting paid more for high yield. You're taking more risk. So I'm very interested to see how that flushes out of the system. Which prices move higher? Does it work in lockstep, right? Does the high yield market rise, right? Because the cash market sort of rose, and we'll see. So as we sort of continue going, again, we talked earlier about stock markets, et cetera, being, or equity markets move based on forward earnings. I'm sorry, forward projections. Let's talk about PE ratios.
Yeah, so, you know, PE ratios, you know, S&P 500 now, right, sitting at 17.3 in terms of forward earnings. Now, obviously, we don't know, these are earnings estimates, but, you know, quite a bit cheaper than stocks were just a year ago, right? And all else equal, right, starting yields, lower PEs, right, lower valuations, not a bad indicator of long-term stock returns.
Yeah, so those are the themes. We talked about some takeaways. Now let's talk about macroeconomic.
Sure. So, you know, I think for this section, we'll maybe go through some of the highlights. You know, we're not a macro firm by any means, but I think it's important to look at what's actually going on in the economy as opposed to what folks may be hearing or seeing in the news. So, you know, in terms of GDP, right, towards the end of the year, we actually saw those numbers accelerate a bit. And growth may be moderating, but it's still positive. Earnings, you know, earnings being the ultimate drivers of stock prices, right? Again, you know, earnings may be moderating a bit, but they are still positive and they're still expected to continue to be positive. And, you know, when I say earnings being the driver of long-term stock prices, right, these aren't just tickers on a screen. These are shares of actual businesses, of companies that make money, that distribute cash flow. And because those earnings have continued to rise over the years, the stock market continues to rise. And that's all this chart is showing you, right? In spite of, you know, countless recessions and corrections along the way. And we don't think that is fundamentally changing, right? Companies haven't forgotten how to make money. might be different types of companies, different environments, but that relationship hasn't changed.
Wait, so you mentioned the R word, Josh, and that's sort of been the headlines. Everyone's talking about it, right? I would love for you to just, what is a recession? You know, what's going on in the marketplace right now? Is it a big deal if we go into a recession? Obviously, there's different recessions. There's shallows. There's big, deep recessions. Kind of, what's your perspective?
So it sounds a little funny to say that this is kind of the fun part. You know, recession's not being fun in the conventional sense, but I think, you know, as far as an academic, we can't even agree, right, as a consensus on what constitutes a recession. They're only declared after the fact. The White House a few months ago had to come out and issue a correction because, you know, we had 2 consecutive quarters of negative GDP growth, which historically has often been associated to recessions, but not always. So it's actually the NBER that formally declares a recession after the recession has often occurred and sometimes even ended. They haven't done that yet. And while there are some pockets of weakness and some areas that are softening, when we look at the data, right, a lot of it is not recessionary, right? Employment numbers, industrial production, output, consumption, right? These are not looking recessionary. And in fact, in many cases, they are better than the numbers that we had pre-pandemic. So, you know, to think that we're all the way back and then some from those levels, that's not really screaming recession. You know, other data points, look at household savings. The consumer has really never been in better shape.
Strong.
Credit, right? Delinquencies, those are low. So, you know, personal consumption, I mentioned, it's high, and unemployment, right? You know, we may well go into a recession, but if we do, it's probably going to be the most anticipated recession ever.
Right, no one gets hit by the bus, they can say.
Right, and how often do we get a recession where unemployment is at 3.5%?
Yeah, non-existent relative.
So, yeah, now Dan, the other part of your question though is if we do,
well,
or if we are
right
in a recession, and we'll only know after the fact.
Yeah,
right?
I almost, in Q4 conversations, I almost wanted someone to say, okay, we're in one.
Yeah.
Okay, move on.
Yeah,
Right, let's go.
I mean, this, I agree with
Or
you,
not.
right?
Just
I
declare
agree.
it and then
We
move
get
on.
kind of tired of hearing about it, but even if we are, or we're headed towards, does that mean that you sell all your stocks? Well, no, a recession's not a reason to sell.
Right.
And we've seen over and over and over again, markets have been resilient, and also, right, the market is not the economy. And that, I think, is a really, really key point. By that, what we mean is looking back historically, and this chart from Avantis, I think, really does a great job of driving home that point. We've had the strongest returns during the second half of a recession, right? Because you talked about it, right? Economic data being backwards looking and the stock market being forwards looking. It's anticipatory. It's a discounting mechanism. So whether we're in or we're headed towards a recession, that's not a reason to sell. The best returns often occur during or coming out of a recession. And we've seen time and again when we look at prior recessions, right? What happens is the S&P 500, the stock market, bottoms before GDP and payrolls and earnings catch up. So this idea of waiting and seeing, are we in a recession? When are we out of a recession? I'll invest then.
Exactly.
That doesn't work.
Josh, going back to the previous slide. Again, we'll send the slide deck to everyone. We know this is quite small, but these are just 6 different iterations where the recessionary environment and the stock market didn't necessarily move in lockstep with each other. Actually, not necessarily the opposite, but actually there was plenty of divergence there.
Yeah, it's a great point. It's not that we handpicked these 6, right? This is what happens every time. So, and JP Morgan dissected it, right? They looked at every recession. We saw it in 2020 with COVID. We saw it in 08, 09, right? Markets bottom, right? And Buffett wrote that famous letter that he's buying stocks and you should too, right? He wasn't the New York Times, right? That was, I think, October, November of 2008, right? It wasn't March of 09 at the lows. He was early, but he said, if you wait until the robins or the bluebirds come out, I forget his metaphor, right? Spring will already be here. So whether a recession's here, whether it's coming, right, that doesn't tell us a whole lot about the stock market, and certainly doesn't inform how we're handling our investments.
Yeah.
And, speaking of 08, 09,
Case in point.
right? I mean, this is, kind of where Buffett is buying, right? And he got ridiculed at the time, right? It was not popular. It was not consensus. The market, this blue line or green line, did go down further, but look how much it recovered before the end of the recession was announced. So the vast majority of the pain occurred before the recession, and the vast majority of that recovery did as well, before the recession was called to an end.
Great. So that really walks us through some of the 2022, what's gone on. We talked recessionary, macroeconomic. I think for the last couple minutes, what I'd love to do is talk about some of these market dynamics, right? You speak about it in our investment committee meetings all the time, but there's certain happenings in the marketplace that happen all the time, and stay invested, evidence-based. So I'd love to sort of just quick hits, go through a couple really interesting charts for the folks that have joined us. And I think these are the things that very much drive portfolio changes, or not changes for that matter.
Yeah.
They drive allocation, they drive sticking with good portfolios, et cetera, et cetera. So we can just dive into some of these market dynamics. The first one's my favorite, right? Because everyone's looking at one number for year end, calendar year over year. How did the market end? But no one's thinking about what happened during that calendar year.
Yeah. So I may get some hate mail after this. I think I said that recessions are interesting. I'm going to say something else that maybe is a little bit controversial. Losses are normal, right? We don't want them. We don't like them. We don't, they're never fun. But the reason why markets go up and stocks can do 10% a year on average is because from time to time they crash. If they only went up and there was no risk and there were no periods where stocks got chopped down by 25 or 30 or 40%, they would not achieve those same long-term returns. So, we look at what happened last year, 25% peak to trough decline. It was very painful. It's not fun. But this happens every few years. That type of a decline happens, and the market, as you've all seen in those charts, has gone up exponentially, right, over the past 100 years, in spite of that, or perhaps because of that.
And this one's great too, because you can dwell and go on and on about bear markets or negative markets, right? But if you look back over time, I love this chart right here, going back again almost 100 years. Almost 100 years. Markets go up a lot.
That's right. Markets go up a lot. Markets go up, right, more often than not, right, about 3 out of every 4 years. And the other thing that this chart is showing you, like here in blue, you've got all the bull markets, and here in red are the bear markets. And it's pretty apparent that the bull markets, right, tend to last a lot longer, tend to extend a lot further,
right,
than these bear markets. And we're not going to get into the whole question of market timing, but it always amazes me, right, when you look at the data this way, how folks are so focused on trying to avoid that right there,
that tiny little,
right, all of that. And this is not unique to that period in time. This is how markets work. This is the price of admission. It's never painful in the moment, but we know it always sets the foundation for the next leg up.
Yeah, and the next graphics I think are so interesting. It's just sort of hitting home the concept of markets are going to do what they do over time. There's tremendous pressure for stocks to move higher. We talk a lot about the reason that they move higher. Obviously, there's so many different characteristics of why markets move higher. One of them is when stocks are going down, right? Some stocks just go bankrupt and they come out of the market, right? But over time, and with this chart, I love this one.
Yeah, and stocks go down all the time, and many stocks never recover. But the market, right? We talked about it being cap weighted, right? The biggest, most valuable companies get the biggest weighting. So even those companies that go bankrupt are naturally replaced by new and emerging technology companies that are now thriving, so that if you own the market, you're always going to own, right, the biggest, the best, the winners. You're going to own some of the losers as well, but you're going to do it in a systematic and rules-based way. And I think that speaks to the difference between investing and gambling, right, or speculating or short-term trading, because they're two very, very different things. I was away last week, Dan. As you know, we were at the Atlantis, and they've got a casino, and I was with my kids. We're not gambling. We're not gamblers, but you got to walk through the casino to get anywhere, right? Not surprisingly. And I was thinking of this image, because we all know casinos, right? They don't close their doors. They're open 24/7, 365, and it's because they make money 24/7, 365. Like, yeah, they might have a bad night, a bad weekend, but they know the longer they stay open, they've got that edge. They're the house, and over time, that edge results in them making a lot of money. The stock market operates the exact opposite way. If you're an investor, right, from one day to the next, it's a coin toss. Stocks are up, stocks are down. The further out you go, 1 month, 1 year, right, stocks up 3 out of every 4 years, 5, 10, 15, right, to the point where there's never been a 20-year period where stocks weren't up. So you are the house, you have those odds. Not only that, right, the Atlantis isn't publishing data on which of their slot machines pay out the best and how much, whereas stock market, right, any 10-year-old with an iPhone can give you data on any public company, right, cash flow, earnings, revenue projections. You've got all of that information, you've got that edge, right? So the whole goal is to stay invested, to earn that premium. And you do have to earn it. You have to endure volatility along the way. But I thought that anecdote, it just really drove the point home for me, in that investing in those terms is very different from what we think about with other items that entail chance and risk and luck.
For sure. And the one thing we hear all the time is this time's different.
Yeah. So the 4 most dangerous words in finance, right?
For sure.
This time is different, and look, every time is different, right? Yes, what it seems like things that never happened before are happening all the time, right? Global pandemic that shut down the world, right? That's the type of thing nobody could have fathomed, and guess what? The stock market is still up, right? Yeah. From that point forward. So whether it's Fed policy, whether it's inflation, interest rate, whatever the concern of the day is, right? It's no different, right? The names, the topics, the headlines might be different, but we've seen over and over and over again, stock market has fallen, stock market has always recovered 100% of the time through thick and thin, and we expect it's going to be no different this time.
For sure. Yeah. No, I think it's a great way to end. Josh, thank you so much for all your great work and your time. Thank you everyone for joining us. Look ahead, we've got Secure Act 2.0. Megan and Rob from our financial planning team are going to talk through some of the new components of that act as it relates to the individual. And then John from our business solutions team is going to talk about Secure Act 2.0 for the business owner. So stay tuned for some of those upcoming webinars. And thank you again for spending your Friday morning with us, and have a great weekend.
Thank you.